Interest rate swaps are contracts, also called derivatives, that are used by financial institutions and corporations to convert fixed rates into floating or floating rates into fixed. One of our clients is a Boston area bank, a commercially focused financial institution that competes with larger financial institutions like Bank of America. What they found over time was that they were losing many of their loans to these larger competitors. Why? Because these larger competitors were able to offer longer and longer term fixed rates beyond a threshold that the bank was comfortable matching. So what they did was they entered into a program with BMO Capital Markets where they ran what's called a matched book program. They would offer a floating rate loan to the borrower with a swap attached to it, and then simultaneously enter into a swap with Bank of Montreal. The end result of this is that by running a matched book, they were able to offer longer-term fixed rates in the market and compete effectively with a multi-trillion-dollar financial institution like Bank of America. So they were beating Bank of America at their own game. The other benefit was by using this program, they were able to use the swap to generate fee income, which they got to realize today. The third benefit is that they got a better asset liability profile because they were able to book a 10-year asset, but on a floating rate as opposed to a fixed rate, which every institution should be considering given where we are in today's rate environment. Well, the board is always involved in this. The board always has a role, and before any program is instituted, the board has to approve it, not only in terms of the activity, but in terms of who their counterparty is going to be. One of the benefits of working with the Bank of Montreal is that we bring a very strong balance sheet and credit rating and swap capability into the equation. We had a Midwest client that was looking to increase some of their funding by taking down FHLB funding. And one of the things that they considered was a fixed rate bullet. What they decided to do instead is take down floating rate funding for 6.5 years and then execute an interest rate swap to swap it from fixed into floating. But this particular interest rate swap would not become effective for the next 18 months. So what the institution was able to do was achieve funding at LIBOR flat, which would then convert into a fixed rate 18 months from now. And so it allowed them to blend in what their current rate view was, which is no Fed action for the next 18 months, but then also give them a comfort, the ability to know what their fixed rate would be beginning in 18 months and then continuing for the next 5 years. The board was always involved in any derivative activity, and their role was to evaluate what the strategy was and to approve it. And they gave it a cursory look, but at the end of the day, they put it off onto their ALCO team, and their ALCO was responsible for the decision, both the idea as well as the execution level.